Welcome to The Explainer. Today, we're taking a really close look at something that acts as your ultimate financial report card, your credit score. Whether you're aiming to buy your dream home, get a new car, or honestly just want to master your personal finances, this three-digit number directly impacts your borrowing power. It's basically the invisible key that unlocks, or entirely blocks, your biggest financial goals. Okay, let's dive into this. Ever wonder what lenders actually see when they look at your name on an application? Just imagine walking into a bank, and before you even say a single word, they already have this deep mathematical prediction of your financial reliability. They don't just see you, they see a track record. And that is exactly what this number does for them. So, to make sure you have complete control over that track record, here's our roadmap for today's explainer. We'll be demystifying the credit score, understanding the score ranges, discussing why your score matters, looking at the math behind the score, and finally showing you exactly how to boost it. Real quick before we jump into the details, if you want to keep making smart financial moves and stay on top of your money game, make sure to like this explainer and subscribe to the channel for more smart financial advice. All right, Section 1, Demystifying the Credit Score. More than just a number. So what is this thing exactly? Well, simply put, a credit score is a three-digit numerical prediction of your credit behavior and the likelihood you'll pay back loans on time. Based on data from our sources, bureaus like Equifax, Experian, or CRIF, they collect your financial history to generate this number. It's essentially a risk prediction for lenders, right? It tells them in a matter of seconds if you're a safe bet, completely saving them from having to comb through years of your bank statements manually. It's just a remarkably efficient trust metric. Now, you might be wondering, does this just apply to me? Well, it's important to note the distinction between personal and business scores. While you, as an individual, have a personal credit score that evaluates your creditworthiness for things like mortgages and personal credit cards, businesses actually have them too. A business credit score evaluates a company's financial reliability, helping them secure corporate credit and build vendor trust. If you ever start a company, you'll be juggling both. But for today's journey, we're going to focus entirely on your personal score. Moving on to Section 2, Understanding the Score Ranges. Where do you stand? Let's move to and see how this builds across different regions. Scores generally start down around 300, but look at the top end. In the US standard, using models like Equifax, the maximum is usually 850. Meanwhile, the India standard, utilizing bureaus like CIF, goes all the way up to 900. Now, anything in that bottom tier is considered poor, which means you'll likely face steep, punishing interest rates or just flat-out rejections. It's a tough place to be for sure. But as you move up into the green, establishing good or excellent credit, that is when the financial world really opens up to you, offering you huge leverage and choices. So, what's the actual magic number you want to strive for? It's 750. A score of 750 or higher is generally considered the golden benchmark for excellent credit across most models. Hitting this target unlocks the absolute best approval odds and the most favorable terms lenders have to offer. But why go through all this trouble? Let's get into Section 3, Why Your Score Matters. Unlocking Financial Doors. Listen, your credit score isn't just a vanity metric to brag about at dinner parties. It has massive, real-world stakes that impact your daily life. A strong score means dramatically higher chances of loan and mortgage approvals. But honestly, more importantly, it directly translates to lower interest rates on borrowed money, literally saving you thousands of dollars over the life of a loan. Think about this for a second. On a 30-year mortgage, even a 1% difference in your interest rate changes your monthly payment drastically. We are talking about potentially costing or saving you tens of thousands of dollars overall. That is the true power of this number. It also gives you better eligibility for premium credit cards with great rewards, higher overall credit limits, and even better insurance premiums and tenant screening if you're looking to rent an apartment. Because this is just absolutely crucial information, take a second right now to share this explainer with a friend or family member who might be preparing to buy a car or a home. Trust me, they're going to thank you when they see those interest rates drop and their buying power skyrocket. All right, Section 4, the math behind the score. Opening the black box. How exactly are these credit bureaus calculating your number? Now, what's really interesting about this is that the calculation isn't magic. It's a very specific breakdown of your financial habits. First up, your payment history. This is the heavyweight champion here. Your track record of paying on time is quite literally everything. If you miss payments, lenders get incredibly nervous. But lenders also care about how much of your leash you're actually using, which brings us to credit utilization, your current debt versus your total available credit. Then there's the balancing act, known as your credit mix, meaning how you juggle revolving credit, like credit cards, alongside installment loans, like mortgages. The passing of time plays a huge role too. Your length of credit history proves long-term reliability. And finally, new credit inquiries matter. I mean, if you apply for 5 credit cards in a single week, it signals sudden desperation, making you look highly risky to lenders. When it comes to that credit utilization we just mentioned, the crucial point is this number right here, 30%. You absolutely want to keep the amount of available credit you use under 30%. So, let's say your credit card limit is $10,000, you should try to never carry a balance higher than $3,000 at any given time. Keeping this ratio low signals to lenders that you aren't overextended and that you manage your money remarkably well. I also want to take a quick moment to debunk a massive myth, the difference between a hard inquiry and a soft inquiry. A hard inquiry happens when you make an actual loan application, and yes, that can temporarily lower your score. But a soft inquiry is when you just check your own score. Let me repeat that. Checking your own score is a soft inquiry and has absolutely zero negative impact. You can and should monitor your score regularly without any fear of it dropping. Which brings us to our final part. Section 5, How to Boost Your Score. This is your actionable playbook to master your financial health. Building and maintaining a rock-solid credit score doesn't happen by accident. It requires a disciplined routine. So here is a practical 1, 2, 3, 4 checklist for you. First and foremost, you must pay your bills and EMIs on time, every single time. Set up auto pay if you have to because consistency is king. Second, to support this, make sure to keep those credit card balances low, remembering that golden 30% rule we just talked about. Third, while you're building this stability, you need to limit your applications for new credit. Seriously, don't fall for the temptation to apply for every store card you're offered at the checkout counter just to save 10% on a t-shirt. And lastly, step 4. Actively defend your score by regularly checking your credit report for errors. Sometimes the bureaus just make data entry mistakes, and successfully disputing an error can give your score an instant, well-deserved lift. Actually, scratch that. There's one more major trap you need to avoid. A very common financial myth is that closing an old, unused credit card will boost your score. Do not do this. Closing an old account actually shortens your overall credit history length. And even worse, it reduces your total available credit, which in turn mathematically drives up your utilization ratio. It does the exact opposite of what you intend and can seriously hurt your score. Put that old card in a drawer, maybe use it for a small subscription just to keep it active, but definitely keep those old accounts open. Wow, we have covered a lot of vital ground today. Don't forget to like, share, and follow for more financial explainers. Understanding your finances is a continuous journey, and we are right here to guide you every step of the way. Ultimately, your credit score is an incredibly powerful tool, a tool that is entirely within your control. By staying disciplined, paying on time, and keeping your balances low, you can use it to build your ideal future. So I leave you with this. What financial door will your credit score open next? Think about it. Start building your score today, and we'll see you next time.